Welcome to this session on foreign exchange spot markets. In this module we will explain how to interpret an FX spot quote, define the terms depreciation and appreciation, describe how money can be made or lost from a movement in exchange rates, and explain the concepts of long and short. Imagine you were in Canada and needed a can of your favourite beverage. How might you express this price? Perhaps we could say that the can costs you $1 CAD and 26 cents. But suppose that instead of a beverage I asked you the Canadian dollar cost of $1. I bet that your brain has just experienced a mini short circuit. Somehow the price of a tangible commodity is easy to understand, but an intangible, such as another currency, less so. Some former training colleagues from UBS had a wonderful saying: foreign exchange is not difficult, it's just confusing. In this module we will be looking at spot market quotations. This is a transaction where cash flows are exchanged 2 days after the trade date. Using our example of US dollars and Canadian dollars, represented by their 3-letter standardized codes, we could write the quote formally as $1 is equal to $1 and 26 cents. Quotes are normally expressed to 5 or 6 decimal places. Although there is not a great deal of consistency of terminology, I will refer to the currency that comprises of one unit as the base currency and the currency expressed in variable amounts to the right of the equals sign as the quoted or counter currency. In the overview module, we established that the market was dominated by US dollar transactions. However, it does not follow that the US dollar will be the base currency for every transaction. For example, when quoted against sterling, GBP is by convention the base currency. 2 other noticeable exceptions where the dollar is the quoted currency are worth mentioning: euros against US dollars and Aussie dollars against US dollars. To figure out whether a currency is a base or quoted currency, then we can apply the chain rule. This outlines the order that is generally followed when quoting currencies. Euros come first, sterling, Aussie dollars, New Zealand dollars, US dollars, Canadian dollars, Swiss francs, Norwegian kroner, Swedish kroner, and then Japanese yen. So if you were dealing Canadian dollar versus sterling, then sterling is the base currency and Canadian dollar is the quoted currency. Although the chain rule is a useful guide, it is worth mentioning how confusing quotes can become. In the wholesale market, we could normally quote euros as base and sterling as the quoted currency. However, if you are buying some currency from a British bureau de change, then it is likely that the quote will be expressed the other way round, that is, euros per unit of sterling. It may also be true for the UK market that smaller and medium-sized corporates would also quote this currency pair using so-called retail conventions. It is possible to decompose an FX quote into component parts. Take the following quotation. The figure to the left of the decimal point and the 2 values to the right of this point are referred to as the big figure. The 3rd and 4th decimal places are referred to as the pips, or less frequently, as the points. FX traders would normally just quote the pips to another participant on the basis that a professional trader would be aware of the big figure at any point in time. Dollar yen is slightly different in that the big figure is everything to the left of the decimal point and the pips are everything to the right. So far we have only presented the quotes as a single value. Delving a little more deeply into the FX quotes allows us to expand the quotation to allow for a buy and a sell price. In this quotation we include a bid price and an offer price. Note that some markets, such as the US, will refer to the offer price as the ask price. How these prices are interpreted depends on who you are in the market. A so-called market maker is a professional trader who is willing to quote a buy and a sell price to any customer without knowing what their intentions are. It is easier to refer to a market maker as a quoting bank. That is the entity that posts the quote to the market. Going back to our holiday money analogy, the bureau de change is the market maker, as the customer will be buying or selling at their quoted prices. At the bid price, the market maker will buy the base currency. At the quoted price, the market maker will sell the base currency. Notice if they were able to execute both trades at the same time, they would buy £1 sterling and pay $1.3752 and then sell the pound to earn $1.3754. This would end up with no pounds but a $2 pip profit. This is why the offer price is higher than the bid. A so-called round-trip transaction would therefore always result in a profit for the market maker. When I was teaching myself FX many moons ago, I developed a simple aide-memoire that I still use to this day, and that is, a market maker buys the base at the bid. All the B's. It follows that they must be doing the opposite action at the offer price, and the customer with whom they are trading will be doing a mirror set of transactions. Having considered the price from the quoting bank perspective, let's have a look at the customer's perspective, sometimes referred to as a price taker. But what do we mean by a customer? Well, in this instance, it is a calling bank, an entity that is willing to deal at the quoting bank's rates. The reason I'm defining it in this way is to illustrate that it might be possible for a bank to be a market maker for one transaction and a price taker for another. In this case, the calling bank will buy 1 unit of the base currency and pay the higher of the two prices, the offer price. Selling the base currency will be transacted at the lower of the two prices, the bid price. Notice that the calling bank will get the worse of the two prices depending on what they want to do. Do you want to sell the base currency? You'll get the lower of the two quoted currency values. Do you want to buy the base currency? Well, you'll have to pay the higher of the two quoted currency values. For a round-trip transaction, a calling bank customer, where they simultaneously buy and sell the base currency, would therefore result in a $2 pip loss. This is the mirror of the profit made by the market maker. In this slide, we show the sterling-dollar exchange rate on the y-axis and the passage of time on the x-axis. On the left-hand side of the chart, sterling is trading at $1.22 before moving towards $1.43 about a year later. This is referred to as a sterling appreciation. Sometimes it might be termed a strengthening of sterling. The idea is that 1 unit of sterling is buying an increasing number of dollars. Where it gets confusing is the terminology applied to the quoted currency. Here we say that the dollar is depreciating or weakening. The problem is, though, what we are seeing, an increasing number of dollars, is contrary to what we are saying, a weakening. I think it's better to think of it as follows. At the start of the period, an investor would only need to give up $1.22 to obtain £1. 12 months later, they would need to give up more dollars, i.e. $1.43, to obtain the same amount of sterling. Therefore, we can see that sterling depreciates as it is worth an ever smaller number of dollars, and so we can say that the dollar is appreciating. We now have to give up a smaller number of dollars to obtain £1. It's worth noting that the depreciation and appreciation can only be applied to a single currency pair. It is not necessarily true that if a currency strengthens or weakens relative to one currency, that it will do so against all other currencies. Why might this be useful? We can use this knowledge to think about how domestic currency values of foreign currency assets or liabilities might change as exchange rates change. Suppose we have a UK exporter who has sold a product or service to the US and is owed $100,000. They have issued an invoice which they have marked as being payable in 3 months. Let us start off by saying that at the current rate of exchange, that is $1.3753 to the pound, that the $100,000 receivable is worth $72,711. But what would happen if the exchange rate subsequently moved to $1.45 before the invoice is paid? The dollar receivable is fixed, but the sterling value now falls to 68,966. This is an appreciation of sterling. One way of thinking about this is to understand that you now have to give up more dollars for every pound sterling. But since you've got a fixed amount of dollars, it will buy you fewer pounds. But the sterling dollar exchange rate is not fixed. Suppose that the rate moves to $1.30, which is a sterling depreciation. The popular press may start to make noises suggesting that it is the end of the world as we know it. But for our exporter, it means that their sterling proceeds will increase by just over £4,000. Admittedly, a UK importer or a holiday maker visiting the States would suffer in this scenario, but the example serves to point out that the exchange rate movements are not always bad. Some phrases which people may assume are easy to understand can, in reality, be very confusing. Here we focus on 2 tricky ones. If we talk about a long position in a financial asset, we're describing a situation where we will make money if its price rises and will lose if its price falls. Perhaps a simple example will be the purchase of a share at $10. If the price moves to $11, then we've made a $1 profit. Less intuitive is a short position. This describes a situation where we make money if the price falls and we will lose money if the price rises. Within an equity context, this is often described as a so-called short sale. Despite what the popular press might say, however, it is not a situation where you sell something that you don't own. That's called theft. Although somewhat outside the scope of the course, to short sell an asset you need to take full legal ownership before selling it and then buying it back at a lower price. Anyway, I digress. Okay, so let's put this into an FX context. Since we are simultaneously buying one currency and selling another, we are in a sense both long and short. But to go back to our equity example, if you buy a share, you are long the share, but you're short the cash. Let us say that a UK company is importing goods from the United States. They will need to sell some sterling and buy some dollars to pay the invoice. They are long sterling as they already own it, and they're short US dollars as they are yet to buy it. So if they sold £100,000 at a rate of $1.40 to generate the dollars, they would generate proceeds of 140,000 US. If they were to sell the same amount of sterling at $1.50, they would generate $150,000. Here we can see that this sterling appreciation has benefited their long holding of sterling. Now take a UK exporter to the USA who will be receiving dollars and converting it into sterling. They are long dollars as they're going to receive this money, but they're short sterling. The key here is to understand that they currently do not possess the sterling. If they were to receive $100,000 at a rate of 140, this would translate into 71,429. But if the dollar price of a unit of sterling increased to $1.50, this would result in reduced proceeds of 66,667. This confirms that being short an asset when the price increases will result in a loss. When it comes to currencies, it's common to represent profits and losses diagrammatically. In this diagram, on the y-axis, we have profits above where the 2 lines intersect and losses below. At the intersection is the break-even. The horizontal axis represents a variety of possible sterling US dollar exchange rates. The diagram is showing a what-if scenario. What will be the profit or loss on a position if exchange rates move to a certain level? This is shown by the 45-degree line running from bottom left to top right and relates to the example of the UK importer we had introduced previously. Suppose that an investor owns £100 million at the current exchange rate of $1.30. This is a long position. At this rate, the sterling amount translates into 130 million US dollars. If the exchange rate moved to $1.35, that is, a sterling appreciation, the sterling sum would equate to a higher dollar value of 135 million. In this example, we're illustrating an unrealized profit or loss, sometimes referred to as a mark-to-market value. I've always thought of this phrase as being very clumsy, but it is asking a simple question. What is the position currently worth? Well, here the answer is 135 million, resulting in an unrealized profit of 5 million. This is calculated as a positive notional value of the base currency multiplied by the difference between the new spot rate and the initial spot rate. Here we see a short position in sterling. The axes are the same as the previous slide, and the various profit and loss scenarios are shown with another 45-degree line running from top left to bottom right. This example is based on the UK exporter who is being paid in US dollars and will need to convert this into sterling. A lower exchange rate will translate into higher sterling revenues and therefore a profit relative to the exchange rate used when the invoice was issued. A higher exchange rate translates into a lower sterling revenue and therefore a relative loss. The profit or loss from this position can be calculated in a similar manner to that shown in the previous slide, with one small difference. Although the profit or loss is expressed in the quoted currency, dollars in this instance, the notional base currency now has a negative sign in front of it. At a rate of $1.30, buying £100 million would cost you $130 million. At a rate of 135, the 100 million will cost you $5 million more. In our earlier example of a UK exporter, we had illustrated how a fixed amount of dollars would translate into a variable amount of sterling. We're saying something similar here. If you want a fixed amount of sterling, the amount of dollars required will vary according to the exchange rate. So what are the key takeaways? The quoted currency is a variable amount that can be traded per unit of base currency. Although dollars is a dominant FX currency, it may not always be the base currency. We can decompose a quote into the big figure and the currency pips. An appreciation or strengthening occurs when one currency becomes worth a greater amount than the alternative currency. If one currency appreciates or strengthens, the alternative currency will depreciate or weaken. Being long a currency means that you will benefit if the price rises. Being short a position means you'll lose in the same scenario.